Awesome. Anyways, really glad that you guys are here. Who am I handing it off to? Scott or Rich today? Who starts? Oh, I need to make you guys both co-hosts as well. I'm so sorry.
I'll share my screen if you'll let me.
Yes. Here we go. All right. We should be good to go now.
One. Can you see my screen?
Yes, I can.
Fabulous. Well, thanks for letting us join you. Accountants, we're not too creative, so in an effort to get everyone's attention, we say PPP loans undressed. We can't say naked because we're accountants. Nevertheless, hopefully we got someone's attention with that. Slideshow, view, read. There we go. So I'm Rich Lockwood from Blankenship CPAs. I'll represent the assurance advisory person of the discussion. Scott Felts, also joining us, represents the tax and advisory portion, expertise. So let's roll through this just a bit. So in an effort to not get sued, here's our disclosures that say this is not tax advice. If you have questions, we can talk about them, but this is not formal tax advice. Makes sense?
We agree.
We will, we want to run through kind of where we were, looking back to what we understood in April of 2020 at the beginning of this whole thing. We'll kind of see where we are today, and then what next. Now what do we do for financial statement reporting, taxes, applications for forgiveness, and some other key things. We've got some prepared Q&As to the extent that people don't have additional questions, but if you do, we'll be able to run through those as well. And then we can point you to where, if you need some help, further help, where that's gotten. So just real quick, Blankenship CPAs, we've got 115 people across 5 different locations around town. Our newest office, I'm sitting in today downtown over by the public library in Nashville. Our culture and values are centered on real relationships, so we focus on that. So into our prepared remarks. Well, back in April, it was really about the government saying, how can businesses survive? Anything that that could be done to keep getting checks in people's pockets, the federal government made that a priority. To do that, then we kind of viewed it from a firm perspective, 2 different layers of advice that we gave clients back then. And that was, capitalize to viability. Find a way to survive. So if that means, if you've got access to equity capital, get that. If you have access to other debt capital, get that. And if you have access to a PPP loan, working capital, get that. And so that was step 1 of our advice. Step 2 then said, okay, presuming you have enough capital to keep moving forward, this concept of deploying that capital to margin, to say that, when individuals in the business fulfill the function of the business, that might be when restaurants could reopen, that might be people running tables. For accountants, it's certainly people with chargeable time. For people building houses, it's certainly those swinging hammers. So whatever generated revenue that was positive margin, we said deploy to that. When people were kind of revenue margin neutral or less than margin positive, margin negative, our advice was be careful with that. There were other tools that the CARES Act made available or things just before the CARES Act. So the EPSLA and FMLIA were ways that businesses could still fund the operations without this PPP loan. EIDL loans also. We'll focus today on, of course, PPP loans. So deploying that margin, then what is the next step? Way too much information, but just to put up on the board, this is the blueprint for our employers that we put out way back then. And we said, you know, this is kind of how organizations viewed whether or not an employee was margin neutral or not. PPP down here, PPP over here, take care of the house. So out of the Wayback Machine, back into where we are today, and that is, okay, in light of that April 2020 advice, second piece that we gave to our clients, we now say, okay, well, now we're seeing how organizations did in deploying to margin. You know, I presume each of you had the same experience where we said, you know, some people we know, their business just disappeared. Others we know, their business blew up. Zoom, we're sitting on Zoom right now. Who used Zoom before COVID? A lot of people did, but not a shred of what they do today. So how did, we had some clients who are absolutely thriving right now. And that factors in a little bit towards some what to do next, because if they're thriving, they've got income, they probably have cash flow and cash, and Scott's going to remind us that there's an income tax component related to that. Others are just surviving. So they've got access to reserves or access to cash flow, or a path to reserves and cash flow, but not really doing great. They are surviving though. And then there are those that are just dying. And of course, our hearts break for that because they're people that we know, places we invested time, invested money, relationships, and those go away, or at least they change. So we won't talk too much about those strategies today, as much as to say that if for your organizations that find themselves not surviving, it points up to this EAP, this emergency action plan that you know, you need to find a way to cut the losses as soon as possible. So to the extent you find yourself in that position and need help, talk to us. Decent look back as to where we were, where we are today, and now from a PPP forgiveness standpoint, what's coming at us. I'll keep looking at my clock to make sure that we're doing pretty good on time. Scott will do that too. He's got a way to electrocute me from his location to speed me up or slow me down. So where we are right now is we need to estimate forgiveness. And so there are, in those three different scenarios, three different situations, there's different factors. Also for organizations with under $2 million loans and over $2 million loans, that factors into that as well. So the good news for those under $2 million, loans under $2 million, is the organizations, the businesses don't have to prove that they needed the money. And that was a big consideration when we, back in April, we're talking with clients It was really in the context of, we knew some who needed the money desperately. We knew others that didn't know that they needed the money, but the presumption in reading the CARES Act, and our firm read the CARES Act through its formation time, as well as then once it was finalized, we reran everything to make sure that we understood it. We had people reading through the night to make sure we'd get through each of the elements of it. So we really understood it very well. And we also understood the certifications that were appropriate, that were necessary and included in it, including the ones that talked about fraud and the ones that talked about prison. And so for those loans under $2 million, thankfully, with following guidance that need to demonstrate that the organization needed it, was taken away. So that pulls off a huge uncertainty for most of the borrowers. And so some of the tax advice that Scott will mention, there's different tax treatment for those under 2 million and those over 2 million because of that uncertainty. And so Scott will talk to us about that in just a second. Scott, did you want to say something about the $50,000 threshold? I see you. I don't hear you.
Yep. Only to say there is a new threshold, and it really just means it's a simplified version of the form. There was a time when we saw a lot of talk around loans under 150,000 getting automatic forgiveness without any kind of an application process. That got tabled about a month out from the election, and then never got picked up again because of the election. No one wanted to do anything that would make even the smallest of ripple, let alone a wave, before ballots were cast. But then subsequent to that, some fraud started popping up and some things were identified that make us think now that that 150 blanket forgiveness is probably not coming back on the table. The SBA is most likely going to want applications, even for these under 50. It's just a simplified application.
Cool, thanks. So under the $2 million loan, those who are surviving, probably 100% forgiveness, but taxes. And so Scott will talk a little bit about that in just a couple minutes as well. So I'm a financial statement auditor. It's one of the things I do best, presentation and disclosure. It's one of the things that most people don't enjoy. So, however, your bankers, lenders, and other stakeholders might be considerate of your financial position. And so I'll go through some GAAP stuff, generally accepted accounting principles stuff. Scott will roll through some tax stuff. And to the extent that we bore you, just give us a second because there are some significant moving parts that we want to address. So for what you'd want to be able to do for your organization's financial statement presentation is to optimize for whatever's meaningful to your company this year. And I say this year, presuming a 2020 year end, a December 31, 2020 set of financial statements. You want to optimize what makes most sense for your business. So you might optimize for balance sheet, might optimize for EBITDA, and you might optimize for debt covenants, which include or exclude some of those components. So the interesting news from a GAAP perspective is that pretty much anything goes. Let me describe that a little bit. I was going to put up on my whiteboard here, and Scott said, that's nice, but no one can see it. Those who understand GAAP understand that the concept of loan forgiveness, existing GAAP guidance is in place for that. However, the GAAP guidance isn't, I think, relevant enough to be meaningful to this many businesses with this much risk at stake. And so what we're pretty sure happened is that the Financial Accounting Standards Board, the standard setters, said, you know, there's existing GAAP guidance for this, but it doesn't work quite the way that the legislators want it to work. Further, they didn't want to freeze the credit markets. For those of you who went through the recession back in 2008, the credit markets froze out a bunch of people or just locked up. And so the standard setters are pretty sure they went through their diplomatic back channels. It's like Cold War type stuff, US, Russia, back channels to say, you know, FASB, the standard setter says, we're not going to issue new guidance, but here's what y'all all should do. And so we're pretty sure they contacted the big four accounting firms, the large firms, largest firms in the world and in the country, and said, here's how organizations could treat their loan forgiveness. Describe these 4 different ways, and then talk to the AICPA, talk to the SEC, and made sure that everyone agreed that these approaches are appropriate. Because without those conversations being had, there's no other way to describe, based on the information that was made available publicly, there's no other way to say that this is how all 4 of the big 4 firms and some others, RSM, BDO, Grant Thornton, how they all came to the same conclusion. Because they really said there are 4 different ways. It can be treated as debt. Again, this is the forgiveness. It can be treated as debt or an income grant, conditional contribution, or a liability. 4 different ways. And for those under $2 million, those with loans under $2 million, all 4 options are available. What we see most of our clients probably choosing with the least amount of, it's not details, least amount of analogizing is what the standard setters used. They said most people are going to follow that liability treatment. So for those over $2 million, because there is the uncertainty about how much will be forgiven, we expect that most of those organizations are going to present the forgiveness, present the PPP loans as debt, and not recognize any forgiveness until that debt is legally extinguished. The other methods for treatment allow recognition of that forgiveness sooner than legal extinguishment. And though that doesn't make sense, it's what's available. And because they didn't want to, the legislators and the standard setters didn't want to freeze the capital markets, didn't want to block access to capital. Many companies can't borrow more money if they've already borrowed money from the banks, or that puts them into default. Or if they borrow more money, it's going to mess up their loan covenants because of their debt to equity ratio, any number of things. But there were 4 different ways of presenting it. We went through the effort then of saying, okay, for our clients, step back one. So the big 4 firms announced, big 4 accounting firms announced this is proper treatment, and then they pretty much fell off the map. They fell off the map out on the internet at large because their clients were then determined not to be eligible for the PPP loans. And so they sort of stopped caring. And that makes sense. If we've got a ton of clients who are affected by this. Nearly all of our clients are, got a PPP loan. Those who chose not to, they had reasons why they didn't. But most of our clients are affected by it. So we dug in deep to make sure we understood the details. And one of the ways we dug in deep is to also then say, okay, in your financial statements, in presenting these loans, and sorry, we're not going to go through every word on here by any stretch, but we want to highlight the main factor, and that is in the notes to the financial statement, the organization, when there are alternatives available in GAAP, they're required to disclose what those alternatives are and to then describe what alternative they are adopting. And so in this case, we put together for the summary of significant accounting policies, note what the alternatives are, and made room then for the client, for the company to demonstrate or to document.
What's that?
Thank you.
Everything okay?
Yeah, it was, I felt like Psycho for a second, but in a good way. So this would be the policy note that lays out those 4 different options. You can see them, those numbers are 1, 2, 3, and 4. And then I put in bold just to draw your attention to it. The method alternative that the company elects. Then back in the detailed notes for the PPP loan, we put together additional language that would describe whether any of the 4 methods that were adopted, this information would be relevant. It describes the CARES Act, some details about the loan, and whether or not it's legally, because it's not legally extinguished by December 31, 2020, the fact is there's still an unsecured note outstanding. There's some interest rates, 1%. There's a maturity date that might be 2 years, might be 5 years, but bottom line is the loan is still outstanding. Lastly, for that footnote disclosure here, part 2 would be, okay, if the company is treating it as debt, then here's a little bit more details as to what that debt looks like as of December 31. And for the organizations that choose to treat it as a liability, again, we didn't unpack all 4. We thought 2 was probably enough to put you to sleep, unless you're still eating. That, okay, if it's a liability at 12/31, December 31, it's probably been forgiven by this point in time. And so here's a statement that acknowledges that, okay, during the year, the company recognized forgiveness. It's presented as other income on the statement of operations or income. So having raced through GAAP presentation, keep any questions that you have about that. We'll reserve those for the Q&A time. Now I'll kick it over to Scott to run through the income taxes piece. How are we doing on time, Scott? Pretty fair?
Like 12:30.
Cool.
12:30, yeah, okay. So for income taxes, just kind of like GAAP, what Rich said, the IRS will let you treat this any way you want to, but that's provided you do it exactly the way they say to. And so, again, we're looking at, 2 or 3 brackets are thriving, surviving, or dying. And what does that mean in terms of year-end tax planning? Should you plan to file an extension or plan to make an extension payment? And Rich, you advance the slide. And so in almost all cases, we would say tax plan is a good idea. However, in the dying situation, it's probably not planning so much as restructuring and, so our focus is more on the thriving and surviving. And so, in the case of, thriving, we look at this from two different brackets. The over $2 million loans, we do have some flexibility on the tax side, and we're going to cozy up to the Big Four and others that are going to take the position of we don't know. It is uncertain. There is a process here that does leave a door open that there could be elements of this loan that are not forgiven, and in that case, we can look at taking a position of this is a liability on our balance sheet, and this may not be a 2020 expense. We may not pick this up until 2021 when we know that this loan has well and truly been forgiven. That really is only in the over $2 million environment. When we're under $2 million, we feel very confident that the language is such that we are going to be required to call this a 2020 event. And so in that case, what does that mean? Well, there may be some opportunities for doing tax planning or a need to do some tax planning for 2020 before it ends. If you had a banner year, maybe you didn't expect it, but took some of these PPP funds and are coming out on the other side looking good, then the biggest consideration is while the SBA and the legislature said these funds, this money is not going to be considered taxable income, which is great. It's not income. However, it is also not going to be able to be utilized as a tax deduction. And so, if you took out a $100,000 loan and utilized it as your intended to pay employees, well, that's $100,000 of payroll expense that you're not able to take a tax deduction on. And so there are going to be, we have a number of clients and friends that we've been talking to that, while, taking this loan, they were not sure how things were going to go. Hindsight is 2020, and we can look back and say, things really did actually go well. We're sitting in a good position now. We made it through. We have plenty of reserves. This did not impact us in the way that we thought it would and expected it would. So now what? Well, these PPP funds that are not going to be considered taxable income, you also have to consider, well, that's not a tax deduction either. And so if you spent the same amount on payroll in 2020 as you did in 2019 and did not incur any other overhead costs, but you thrived, then your income is either the same or greater. And so you've been able to generate more income with less expense. And so now you may find yourself in a situation of owing some taxes on that.
Hey, Scott.
Yes.
So back in the day, the legislators issued the CARES Act and they said, this is not taxable.
Mm-hmm.
And so many companies took the loan because they said, and
Mm-hmm.
any forgiveness would not be taxable. Problem
Mm-hmm.
was there was some existing law in the Internal Revenue Code that says, well, it may not be taxable income, but the expenses are not deductible. And unless the law changes, unless the Internal Revenue Code changes, that it kind of turns out that they're in substance taxable. So what we're hoping is that a lot of people are going to, well, Scott will talk about that with respect to extending, but it's really to give the legislature time after the election. Back to you, Scott.
To Rich's point, we're hoping that in fact the legislature does say, well, that's not what we intended. But the IRS has made it very clear that they've read the intentions and they've said, well, regardless of what you intended, this is how we're going to treat it. We have law on the books already, and we have pointed the profession to that, which is what Rick highlighted exactly. Is if you have non-taxable income, then you do in fact have no ability to deduct the expenses related to that non-taxable income. And so, in terms of the extension, what we're recommending is probably to do so. Let's extend those returns if we are still waiting on that legislature, and really to try to wait as long as we possibly can. However, with that, we would say, because of the laws on the books as they are now, we would recommend calculating and determining what your liability is if they don't change this and make an extension payment. Worst case scenario, you end up owing a whole bunch with penalties, but if you make that extension payment, then really the worst case scenario is you've given a little bit too much of your money to the government to hold on to for a period of time. And if this corrects itself, then we file the return and request that back. But right now there is some uncertainty on which way is this going to go. We know what the IRS has told us, and that's not favorable. And so our hope is the legislature will hear the feedback and start to respond in the way that really the public felt that this was communicated on the front end. That may or may not be the case. And then timing wise, looking at what is the timing for submitting these applications. When the loans were funded, and the important thing is, so not when the application was submitted, but when the loan was funded. So when the amount hit your account, the clock started, and it was either an 8-week period, which that was the original. The original PPP was only contemplating an 8-week period, and then somewhere along the way, it then got extended to a 24-week covered period. And so, in our example here, we have, April 8th, the funds hit the account under an 8-week period. June 3rd would be the end of that 8 weeks. And then there's 10 months from the end of your covered period to submit the application for loan forgiveness. And so that would take it out to April 3rd of 2021 in the 8-week scenario. In our 24-week period, we've got September 23rd, and then 10 weeks out.
Scott?
Yep.
So organizations can choose between an 8-week or a 24-week covered period. Is that right?
Correct.
Okay. So you didn't default into either 8 or 24. If you spent all the money on covered costs in that first 8-week period, and you just want to get it out the door, get the forgiveness acknowledged as soon as possible, you can use that 8-week. If you didn't have enough covered costs in the 8-week, you can push that out to a full 24-week. There's nothing in the middle. It's either 8 or 24, and that's how that calculates.
There are a couple of other, some questions I've gotten on this are, it looks like I need to submit this by the end of the month. And that has been related to some confusion around the forms themselves having an expiration date. And really that has everything to do with the Paperwork Reduction Act. Actually, the last forms expired at the end of October. The current forms say they expire at the end of this month. And so that's been some of the questions we've had as well. I have to get this thing in. That's not the case. I think really the fact that those forms keep going a month out means they're contemplating changing them yet again by the end of the month. But really the applications are due at the end of the 10 months from the end of the covered period, along with the first payment. And so you'll see that on the graphic. And then the other thing is somewhere along the way, this got split into either a 2-year or 5-year maturity. And that had to do with whether your loan was obtained prior to June 5th or post June 5th. And Rich, did you have anything to add to that?
No, it's just, so it's relevant when we start talking about some things that here in a bit. Some companies might choose not to request forgiveness, and that some of that will be driven by whether it's a 2-year loan or a 5-year loan on the repay back, but that's it for now.
Yeah. And I would concur with that. There's, Rich is going to address, and I'll address, in a minute, some reasons why maybe we would choose a longer period over a shorter period, or why we would choose to use certain expenses over others. But really, again, from a tax perspective, what we're looking at is for our clients or for our friends in the community that either are surviving or thriving, is having those planning conversations now to make a determination of what needs to be done by the end of 2020. How is this current law impacting your business, your organization? Are there things that need to be done prior to the end of the year, or are they better to queue up into 2021? Somewhat going to be dependent on either over or under a $2 million loan. But again, this is going to be determined by, are you thriving? Do you need to, purchase equipment and, that's needed and necessary for the business, and you have some cash flow and you need that accelerated depreciation this year, things of that nature. Do we need to find ways to offset, this tax that's going to be potentially coming from the PPP that, again, when we initially heard this, this was great, tax-free money, we're going to get this, this great helping hand. But now with the IRS taking the stance they're taking, we have to look at the plan on the other side of this. Well, what if you're thriving and the legislature does not change? Then we need to contemplate what is your tax liability going to be, and make sure that we are leaving enough liquidity to cover that, and not end up 2021 in a worse place than 2020 because of this free money.
So I think now we could jump into the Q&A, and one of the ones Scott referenced on the front end was, or not a front end, just a couple of minutes ago, was, hey, wait, I've got an agreement that says I've got a payment due 6 months after my note, and I didn't get anything in the mail. Can we hear you, Zap? We see you, we don't hear you.
Hey, sorry, I'm currently running an event as I'm running this event.
Okay.
What, you're opening for questions?
Let's address two of them quick. We're not going to go till noon, but we have till noon, right?
Yeah, totally. No, we can keep going. I'm wondering if there's any questions from the audience. I would assume so.
Hold that for just a sec. So one was this one about the note pay. Well, hey, it says it's due. No, the legislators came behind it and said the deferral period has been extended. And so your first payment, if any payment is ever due, is not going to happen until 10 months after your loan 10 months after your covered period ended. And so what that means is if the covered period ends June 3rd, April 3rd of 21 would be the soonest you'd have to write a check, if ever. Same thing on the 24-week period. If September 23 was the end of the covered period, the soonest you'd have to write a check is July 23, 2021. So don't worry about those having to write a check between now and then, especially if you're contemplating the loans getting forgiven. Another thing we wanted to mention was that we've got some clients who have overhead rates with the department or departments of transportation that because of the way that the federal regulations are written, they will in substance, they don't have to pay the loan back as such, it can be forgiven, but they will not be able to charge those forgiven expenses, costs into their overhead pool. And in substance then, they'll have to repay that by not being able to claim costs in their overhead rate. So they might choose to not have the loan forgiven if it's cost them more that way in revenues that they can't collect. For we've got some research and development companies, biotech, biopharma, who have R&D grants that support a lot of their operations. Same thing, if those costs are forgiven, then they can't claim those costs for those research and development grants. They might choose to not have those forgiven. They might choose to raise other capital to pay for those costs rather than not being able to get the money from the federal government. Uniform guidance, same thing for indirect cost pools. So we're hoping that the legislators, and there have been requests made by the legislators, by the Engineers and Architects Maine Association has requested clarification, and that impacts these departments of transportation, the FNA, and uniform guidance organizations. Scott, did you want to talk just real quick on R&D tax credits?
Yeah, really just to say, one of the things we've looked at, more of an opportunity is what do we do with the loan application itself? And maybe do we carve things out a little bit differently? Maybe if we have a client that they could do 8 weeks, but instead we choose to do 24 because of the R&D, and do we, instead of including those employees that are underneath the R&D, can we capture different employees? Can we then go pick up the other eligible expenses? Are there ways to be a little bit more creative in reserving those R&D credits and the PPP forgiveness, or maybe not taking full forgiveness, but as Rich said, we consider taking some of that as a very nice 1% loan. That's very appealing if you are going to trade off instead a lucrative tax credit. And so those are things that we've looked at and contemplated. Is maybe it's not one or the other, but we find a hybrid of how do we try to get the best of both.
So Zap, on to you and on to those watching, listening, etc. What questions might you have? I'd say we're all ears, but we're also eyes to see what's coming through the chat.
Yeah, I don't have anyone who tried anything in. Does anyone unmute Darius? It looks like you had a question.
Yeah. So you guys talked about majority of those companies that are 2 million and below. So if you're like right around the, 50, I heard you mention about $50,000, $50,000 range. So I've been, kind of informed that I need to hold off on filling out my application until they get to a point where they have identified who's going to pay back what, who has forgiveness for how much. So I'm just trying to figure out, have you learned any information on, or figured out, have you received any information on where they are with that yet?
Scott, you want to hit that?
I would be surprised anyone, especially if it's coming from the bank, would be asking you to hold off because the bankers are highly incentivized to get these applications in and processed and get the loan off their books. In most cases, the banks have already been paid. And so, right now they're just sitting on these loans, these very, very low interest loans that they want gone. And so, no, from, if you're in a $50,000 range, you're probably, we feel like you're 100% eligible for forgiveness. It's just a question of putting the application together. And again, if you're under 50, there's a different application. It's the S, which I guess means short, because there's also an EZ, which is the next step up, and then a full form. But really then it just becomes a question of what were the forgivable expenses, and how to best get all those captured and put the application together. But again, no, I wouldn't see any reason why, if you're under 50, you would want to hold on to that application. You probably are just as incentivized as the bank to get that together, get that in, and just get that weight off.
Thanks.
Having said that, though, there's no requirement to force anyone to file the application sooner. Some of us have our heads down just trying to make money for the end of the year to pay bills. And so some of that deferral goes along with the application, is to say, you know what, it's not critical that you file the application. And the banks do not have the authority to compel people to file sooner, though they might be incentivized. They're going to be made whole. What they don't want to do is hear anyone say that my bank made me file my application sooner. Well, we've still got mental health issues across the country that we're navigating through. Don't put another pressure on it right now, that being to fill out a form. So when you have questions,
but I think
go ahead, Scott.
Yeah, the other thing too has to do with the way your business is structured. If you're an LLC or a partnership, Schedule C, where you yourself are getting paid through that entity and not through payroll, then the way the taxes work is you don't get to write yourself off anyway. You don't get to write off what you paid yourself. The partnership doesn't get to write off what they pay the partners unless there's a guaranteed payment function in there. And so in that case, you've got not only a non-taxable income, you've got a non-deductible, but that was non-deductible to begin with. And so whatever way the legislation goes, if the bulk of your PPP money is to pay yourself as an LLC owner or Schedule C owner of the business, it really doesn't matter which way the legislation falls. Your piece was going to be non-deductible anyway, and you're already going to be getting the best benefit out of that.
And so in that regard, to the extent that it's taxable, it's because you got the benefit. That's the logic that goes with that. So Zap, I don't see any more questions, but
well, some people can just unmute themselves. Does anyone else have any more questions?
yeah, you don't have to be on video to ask a question.
I know Mason's here, Lauren, Jack. Darius really wants to ask another. All right, I don't think so. I think we're ready to wrap up. Any final notes, guys?
Scott, any on your end?
No, I would just say, if you have questions after this, would love to have that conversation. It's, especially if it gets, out there and in the weeds. That's what we love the most, is to really dig in and, find the fun and the complicated and help you make the most sense out of it. That's what I love. I know Rich loves that too. It's just more interesting. But really, please, if you have any questions, we would love to talk with you, love to help you through this. It is a really, it's an odd thing. The government slapped this together really fast. They did a relatively, good job of putting this together in such a way, especially as fast as they did, but we're still learning things as we go. And, would love to, again, continue to help anyone that has questions navigate through this. It's been a crazy ride, especially for us, watching this thing from, inception to even where it is today, and then continuing to where is it going to end up.
I have one more question. And this is based on what's happening now, and with the virus coming, I guess having the second wave. Do you think there'll be any anticipation of opening any more PPP loan opportunities back up?
So Scott, let me just, what I've heard from the legislators and interpreters of legislators are probably not. That it was the one time, and then they kind of extended it a little bit, but they had really kind of said through the CARES Act that they weren't going to extend it further. However, everything that's come out by the legislators since then has been in favor of the small businesses. They've done nothing really to take away. It's only those areas of the law that were pre-existing that kind of felt like it was taken away. They've been doing nothing but making it easier on the businesses. And so I think if another wave happens, everything's on the table for the legislators now that the election is passed, now that there are not going to be any more politics. And I say that kind of smiling. No, there's still going to be politics, but the interest is in helping the country move forward and helping the businesses move forward. And so under the existing CARES Act, no new money. Under additional legislation going forward, it's possible. So my contact information and Scott's is listed here. The link at the bottom is where you can click on stuff on our website to get more information. If you need help completing your application, there's a link there that you can click on that you can. We've got a full system of people and team in place with quality control reviews behind them to quickly and accurately complete those PPP loan forgiveness applications. We've seen a lot. We'll see, like I said, nearly every business that we serve has a PPP loan, and we're helping on most of those, I believe. If you got questions, find us. If you don't, like George Strait said, honk if you honky tonk, don't if you don't. But no, Zap, thanks so much for letting us be a resource to the EC community. We love the EC. Thanks for letting us be a part of it.
Awesome. Thank you guys both for coming. Thanks for folks for watching, and I'll follow up with everyone else. I'll send you this link. All right. Bye-bye, everyone.